Intuitive Surgical, which makes the Da Vinci robotic surgical system, reported earnings last night, and afterwards shares were down by as much as 8%. Now, while the stock has pared back some of those losses since the market opened, the investors are clearly not pleased with what they heard. But is there much to worry about? Let's spend the next 10 minutes trying to figure that out. My name is Brian Stoffel, and as of the time of this recording, I am an Intuitive Surgical shareholder. Thanks to Y-Charts for sponsoring today's video. We'll hear more from them in just a minute. So this was Intuitive Surgical's third quarter of 2023. It's about a $90 billion company. If we look on the top line, revenue grew 12%. That came in short of Wall Street's estimates. On the bottom line, a better picture. Earnings per share on a non-GAAP basis of $1.46 was up 23%, and that was ahead of Wall Street's estimates. Now, when we look at margins, it's kind of a mixed picture, but altogether a positive one. Gross margins were down ever so slightly, but operating margins and notably net margins showed meaningful expansion from the same period a year ago. Now, the company doesn't release its free cash flow statement with its earnings release, so we'll have to wait on that, but net income was up on a non-GAAP basis, and the balance sheet for this company is stellar. $7.5 billion in cash and no debt to speak of. Now, the headline number when you're looking at Intuitive Surgical is procedure growth, and procedure growth was up 19%. That's a great figure. Areas of strength included general surgery in the United States for benign conditions, and then there was also strength in Germany, Japan, the UK, and India. China, which is a huge growth opportunity, showed growth that was in line with the global average. Now, U.S. general surgery, and again, that is kind of like the bellwether for where growth could go in the future, was very strong. Gallbladder and colon procedures led the way. Ion, which is a new robotic option that hospitals have to do lung procedures, showed 125% growth. That's off of a small base. And the single port procedure growth was up 54%. Now, the normal Da Vinci has multiple arms that can be used in surgery. The single port just has one. It's also worth noting the company placed 312 new Da Vinci systems in the third quarter, which was more than the same time last year. That figure is important. We'll come back to it in just a bit. But overall, there are about 8,100 multi-port Da Vinci systems, 490 of those lung-based Ion systems, and 158 single-port systems across the world right now. This adds to an enormous moat that the company has in switching costs because there is limited real estate within hospitals for such systems. And they said that overall, there is additional demand for the multi-port, that's the primary Da Vinci system, continued interest in Ion, and a modest acceleration in placements of the single port. So all in all, when it comes to placing these new systems, there are strong trends pushing this company forward. Let's go down the income statement to see what's going on here. Instruments and accessories was up 23%. That's fantastic. But systems revenue was down 11%. So let's stop and suss this out for a minute. We just said that they placed more systems than they did last year, but revenue from these systems is down 11%. Bad news, right? This likely is why Intuitive Surgical missed its revenue estimates that Wall Street was calling for the quarter. And it looks like a bad thing because it looks like the company is giving these away for cheaper. But looks can be deceiving because let's dig into why it missed it. It said that the proportion of leases for these new systems was high in the US, and they are seeing an acceleration in leasing, which reflects the convenience of this program. And while it reduces in-quarter revenue relative to the capital purchase, total economics are healthy both for customers and for them. It allows customers to build capacity when and where they need it, and it provides a predefined pathway for new technology to enter the market. Let me just break this down into plain English for you. Intuitive Surgical offers a subscription program, but it's not subscription like Netflix might be. It's a subscription to use their robots. Instead of a hospital paying $1.5 million all at once to get a new system in their hospital, they are instead saying you can lease this either on a calendar-based or a usage-based agreement, and you pay far less upfront, say $100,000, but you're agreeing to pay $100,000, and I'm just using that number, $100,000 per month for as long as it's in there. So it's easier to get that machine in the hospital, and while Intuitive Surgical does have to sacrifice some revenue in the short term, it actually gains more in the long term, and it increases those switching costs because the hospital doesn't have to make some kind of decision when it wants to get the new version of this. It's baked into the agreement that it can get a new one and continue paying that subscription fee. Overall, this is a very, very good thing for long-term shareholders, but it does contribute to a revenue shortfall for the quarter. So moving on from there, we see that service revenue is up 13%. So overall, revenue is up 12%. Okay? The cost of revenue is up 14%. And those leases are a big part of it because you still have to, Intuitive Surgical still has to pay everything for that machine to be made and delivered, and they're getting less upfront. Over time, though, it comes to them. Now, because of that, gross profit was actually up only 11%. That's bad because revenue is up 12%. You want gross profit to grow faster than revenue. However, it can make up for it. How? Its operating expenses were only up 7%. That means that income from operations was actually up 17%. And then look at this. Because the company has $7.5 billion in cash sitting there, finally earning some interest, they made $56 million on this, which means that their net income was actually up 28% on just a 12% jump in revenue. Great news. What about looking forward? Well, management doesn't release guidance. Wall Street's expecting 15% top line growth, 23% on the bottom. The important tidbit is this. They've been continually upping their forecast for procedure growth as the year's gone on, and they did it again. The midpoint used to be 21%. They upped it to 21.5%. So in other words, everything is continuing to look very good for this company. They are, it's worth saying, noted a slowing of bariatric growth. This likely does have to do with Ozempic and its other counterpart, and patients are choosing to try and use this before having surgery. So that might take out some of the growth that the company has. The full year, the fourth quarter, it's already baked in. 15% top line growth, 19% on the bottom is what Wall Street's expecting. What am I going to watch moving forward? First and foremost, that procedure growth. That's important. Number 2, system placements, not system revenue. System placements. Number 3, international growth. And number 4, margins. We're starting to see some very nice operating margins come in with operating expenses. There is no doubt that the moat is widening, in my opinion, on this company, and the thesis is very, very much on track. However, and it scores very well on both of our frameworks. However, we need to consider valuation because that's the other part of why the stock is down right now. Now, this is a company that's between stage 4 and stage 5, which means that we've got a couple of metrics we can look at. And for that, we go to YCharts, a tool that Brian Feroldi and I use almost every day. You can get a free trial of YCharts by clicking on the link in the show notes below and mention Brian Feroldi's name, and you'll get 20% off that free trial. So let's head on over to YCharts. And if we look at the company's PE ratio of 66, we see that that is elevated. It's definitely not cheap on an absolute basis. And even with this company over its past 10-year history, it's elevated. So this is not a cheap stock. If we look at the company's forward PE ratio of 47, that looks more reasonable, but that is still a very high PE ratio. What about if we look at the price of free cash flow? Now remember, we don't have the free cash flow numbers for this quarter yet, but 80 times free cash flow is also very, very expensive. So it's clear that this is a very expensive stock, but that is not the only way that we can look at this. We can also do a reverse discounted cash flow analysis. And for that, we're going to go over to a tool that Brian Feroldi and Brian Withers and I built, a discounted cash flow calculator. Now, if you'd like a copy of this, you can click the link in the show notes below and you can get a copy. And here's how you use it. You put the ticker symbol in here, ISRG. Now, for free cash flow, again, we don't know exactly what it is on a trailing 12-month basis because the company hasn't released that yet. However, it had a free cash flow margin of about 18% heading into this. If we assume it held that, it's about $1.2 billion in free cash flow. Now, we'll give this company a terminal growth rate of our standard 2%. And then when we think about the discount rate, 10% seems reasonable. And then we just need to make these two numbers match. So we don't have to change it too much. If we do, we can see that if we go with a 26% growth rate, that's about what the company needs. Now, 26% growth rate in free cash flow per year, you can do that for a year or two, but this calculator assumes you do it for 10 years. That's a very long time, and that seems like too high a hurdle for the company to get over, which makes this seem like it's too expensive a stock. However, we need to consider that Intuitive Surgical is aggressively reinvesting in opportunities, both via R&D and capital expenditures, so its free cash flow margin is held back. In the past, Intuitive Surgical has had free cash flow margins as high as above 38%. So what if we assume that it could max out at, say, 35%? What would that make it look like? Well, we can go back in and do the math on that pretty simple. If the company had a 35% free cash flow margin, that would be about $2.4 billion over the trailing 12 months. And then that changes this a little bit. Let's see if it knocks down to 20%. We can go even lower to 18%, even lower maybe to 16%. I'd say about 17% is about what gets us there. So what that means is that over the next 10 years, if Intuitive Surgical can get a 35% free cash flow margin, and that's no guarantee, but if they can, with a 10% discount rate, we're saying that Intuitive Surgical needs to grow its top line by about 17% per year over the next 10 years. Could the company do that? That is actually faster than it's grown over the last 10 years, so that is a high hurdle. This is an expensive stock, which explains why it will go down so much, even if it had a relatively positive quarter. This doesn't surprise me. Now, am I going to be selling my shares? Absolutely not. I think this is a very anti-fragile company. It is very high quality, but I'm not going to be adding to it because it is still highly valued even after today's earnings. This is just another one that we're going to check back on in 90 days and see what we think. Until then, Brian, out.